Hey everyone, Ruben Saltzman here with Structure Tech Home Inspections and the Structure Talk podcast. I want to give you a warning before you listen to this particular podcast. There is a ton of technical content here, and our guest, Dan Sibinski, asked me at the very beginning of the show if he could share his screen, and I said I would do my best to share the content with our audience so you could follow along. Well, little did I know how much content there really was to share. If you are going to be listening to this podcast in your car or it's just somewhere where you can't take the time to sit down and look at your screen, I'd invite you to join us next week for next week's podcast, where you will not have to look at a screen to really appreciate the content. There are a ton of graphs, lots of technical content in here. We debated sharing this because there's so much technical stuff, but I think it's fascinating information for anybody who really wants to know more about whether we are in a housing bubble or not. And an alternative title to this podcast might be kind of a follow-up to a podcast we had a couple of weeks ago. And I might say reasons to buy a house today, why you should buy a house today. All right, that's enough. We'll get into the podcast. Just don't say I didn't warn you. I hope you find value in this. Enjoy.
The following podcast is sponsored by Structure Tech.
Are we looking at a real estate bubble? Are we approaching a 2008 experience all over again? It seems like history repeats itself in 7 to 10 year cycles. Welcome, everybody. You're listening to Structure Talk, a Structure Tech presentation. My name is Bill Ulrich, alongside Tessa Murray and Ruben Saltzman. As always, your three-legged stool coming to you from the Northland. We're happy today to have a special guest with us. Dan Sibinski from Keller Williams Classic Realty is here. Hey, Dan, how's it going?
Good, thanks.
Awesome. We're going to dig into a conversation that we've been talking about a little bit around the office. Are we looking at a real estate bubble? Are we approaching a 2008 experience all over again? It seems like history repeats itself in 7 to 10 year cycles. So we're going to pick Dan's brain today and see what he's thinking, what he's seeing out in the marketplace. But before we do that, Ruben, Tessa, you better say hello to everybody. I'm sure they're patiently and anxiously awaiting your tunes. So.
Hello, Structure Talk audience.
There you go.
I'm anxious to hear what Dan's got to say about this because everybody is worried about this right now. I want you to wax on everything, Dan. I want you to tell me if lumber prices are in a bubble right now. Seriously, you go to the store, 2x4s are selling for like what, $7 or $8 right now. It is crazy. So I want you to use your crystal ball and tell us about all of this and where it's going, Dan.
No problem. First, at least we can scrub out the potential of anybody trying to sell that stuff off market. You know how hard it is to carry 2x4s under a trench coat? Not going to happen.
I've tried. Okay, so Dan, tell us, we can bury the lead or you can come right out. Where are you at on this whole thing? Do you think we're in a bubble?
Maybe we have some predictability that we can look at with that. A glass case of emotions, more than likely, yes, for that, the buyers out there. Am I able to share my screen with you guys so you can see some of the stuff that I put together for you in terms of what I use for my communications with buyers and sellers alike? Because this topic comes up almost on every conversation. And if it doesn't, I like to bring it up because I think it's very important for buyers to understand right now where they're at in the market and what they are purchasing. Because you can always purchase wrong no matter what market you're in. It's just how you purchase now is the name of the game.
Please do. And whatever you share, I'll be sure to put this in our podcast notes so anybody can follow along at home.
We call that responsible potting. Sharing a screen to an audience that's listening sometimes is a challenge, but we'll back it up on the backside.
I'll use my hands less if that helps.
Okay, fantastic.
To understand where we are in the market and how real estate itself turns, you have to understand really the three key components of what makes up real estate, which is supply, demand, and affordability. Now, as Bill mentioned at the opening of the show, it seems like things change every 7 to 10 years. You're not too far off from that, Bill. Typical numbers between real estate is anywhere from 6 to 8 years, the market does something different. And why is that? Is it because we've got new people in the office, new people making decisions and policies? Is it because of those policies now, our GDP and the industry, job markets do something different as well? All of that stuff has a trickle-down effect to the real estate market. But when you get down to it, the market is controlled by those three factors. Keep in mind, I'm not an economist. I'm not a loan officer. I'm a real estate agent. So these are my opinions, and maybe I'll be labeled as crazy 10 years down the road. But right now, I feel like I'm that meme that's out there with the lemonade stand saying, I think we're here, change my mind. So let's start looking at what these charts mean and how the general public can understand and really watch the market for its next turn. Has anybody here heard the term absorption rate before?
No.
Yes, with paper towels.
So in real estate, the absorption rate is where they deem a balanced market. Are we in a buyer's market? Are we in a seller's market? How is that measured? It's measured in how many months supply we have of inventory at that period of time that we are in. And if we add no more inventory to the market at the pace that they're selling, how long before everything is gone? Okay. So depending on who you talk to, they're going to tell you between 5 and 6 months is that balanced market. You got a little room to move on both sides of the fence before you go, hey, I'm now in Wisconsin, or now I'm in Iowa. You're stepping over the line. So if you look at this month supply, I've got a red line drawn in there at where I feel is about the 5.5 month line. And I'll tell you why that's important here in a couple minutes. What we're going to focus on this conversation is the fall that we had from 2005 to 2012 and the gains that we've had to now. What a great thing to be able to actually look back on right now and go, okay, well, these are the reasons why the housing market changed then. What happened to those key components and where are we at now? And how is that going to come into play? Right now, you can see my cursor's down at 2021 here, and we are at about 0.8 months. Now, the charts that I'm showing you are from February. I know we're in the cusp here of May. Things are going to trend up a little bit, but some other charts that I'll show you, you'll know exactly what those charts look like. But I didn't have time to put together the fresh stuff for you. 5.5 month line here is balanced, is the tipping point, and we're at 0.8 months with all the inventory that we have. 0.8 and everything is gone. I could say it one more time for the dramaticness of it, but I don't think it's needed.
22 days worth of inventory.
Correct. Now, imagine how much your house would be worth if everybody knew that number and we're playing their odds based off of that. It's like Armageddon for homes out there. And we're feeling it. And that's where you're hearing all the stories in terms of how radical the market is, how much more people are getting for their homes, the contingencies that are built in for extra monies. There's a reason why that's happening. And there's a reason why it won't happen eventually as well.
Hey, Dan, can I just mention one thing about that graph? That's kind of interesting. So on the horizontal axis, it's the year, right? And it looks like it starts at 2004 and it goes to 2021. And
Correct.
on the y-axis, what is that? The months?
That's the months.
The month supply of inventory. So what's interesting is that from 2013 until 2021, that month supply has been less than what you're saying would be the ideal amount, 5.5 months. It's been less than that. And it's been kind of slowly decreasing ever since 2014, 15, it looks like. Is that true?
That is true. When we look at when the median house value started to tip, and we're going to get to that slide actually, you'll know why I'm putting that 5.5 month line in there and why that number is so important to me. And if you remember last year when we were talking about withhelds and this certain percentage of the market that is not in the public's eyes and what that means from a percentage and how this comes into it, there's so many rhymes and reasons of why the housing market is what it is right now. A lot of it's natural, some of it's artificial, but the game has changed to where are we going to get that past time, that past normal back? I don't think so, which you'll get my whole roundup Nostradamus ideas at the very end. But take a look at this when the market really started to fall. Look in 2008. I think that's the year when the government started putting in that incentive, the $8,000 buyer credit to get people, back into the game. We had almost 11 months worth of supply in the Twin Cities. I mean, we were swimming in inventory. What that means for the number of homes is we had, 37, close to 40,000 homes on the market at that time. Right now with that, in February's charts, that 0.8, it's showing under 5,000 units, 4,670 units on the market for all of us to enjoy.
Oh my
for all
gosh.
buyers looking to purchase.
Is this for just the Twin Cities, Dan, or is this all of Minnesota?
Well, it's a good question. I'm not sure if this is the whole area that the MLS reaches, or if this is the 7 metro area. I'm going to default to the 7 metro on it and just hope that it's right. If not, that's where you put the bozo nose on me and amplify the sound.
Wow, but that's crazy, from almost 40,000 units on the market back in 2008 to less than 5,000.
Right. So
Wow.
I look at this chart and I go, if I were to look at one of the metrics in terms of, are we getting closer to a balanced market? If I was an investor or trying to time the sale and knowing what this might mean in terms of how to leverage myself better as a seller or buyer, I'm paying attention to the month supply. I'm also going to pay attention to how many units do we have to play with. Population growth has gone up since 2007. So I would predict that this number to serve that greater population that we have now is going to have to increase as well. So maybe we're looking at a 25,000 unit metric. Maybe it's a little over 25 to get to that balanced market, if you will. I do know that even if we get back to 2 months supply, buyers are going to think that they have it good again. So let's look at the median price. This chart is super important to me for those who are thinking that the housing market follows the stock market. Oh, it's going to crash, it's going to fall. Okay, let's say it is. It's not like a stock to where it's going to just turn down the dial the next day. This thing doesn't turn on a dime. It turns like the Titanic. Just a fact.
Titanic didn't really turn that well.
Tessa.
Sorry. I'm sorry. Sad fact.
This is true. So I put all 3 of these charts on the same page so you don't visually have to go back and forth, but you follow the line 5.5 months and you look at the market saying, hey, something's not right here. Something's going to change. We're not doing the normal things that we've been doing with inventory. I wish this chart went back to 1999 so we could show all the new construction that was going on and deficiency that we had in housing and why the prices started going up. But look what happened. Keep in mind too, during this time, from 1999 to that time, we had lots of factors in the market that we don't have now. We had unverified income, people who were qualifying for home based off of what they said they were making. That doesn't exist anymore. You had people who are robbing all of their equities out of their homes and maximizing the money that they had on paper, turning it into a real money in their pocket, making it easier for them to walk away from their home from. And they were doing it for various reasons, but it was being done at a very, very high level. Even that rate now is being held at a comfortable rate, let's say. So the fear of, a foreclosure market happening right now, it's not really existent. And I'll tell you what, even if it was existent, there is such a low amount of inventory. Let those people go into foreclosure, and that inventory is going to get swallowed up because we're so underfed right now in inventory. Plus, quite frankly, if people are losing their jobs, if the job market, isn't supporting employment, if we get a big change in that area and people do have to go through foreclosure, it's a 12-month process in Minnesota, and they're probably sitting on equity, especially if this happened within the last year, because housing values continue to go up. If they're missing their payments, they're not qualifying for any HELOCs or any money to take out of their home. So they're kind of self-protected in the market that we're in right now, just by default. I think the lender mitigated aspect is going to be very nil. There are numbers with FHA mortgages, being that they've all been suspended in terms of foreclosures, that maybe there might be a wave of them coming. But the last chart I have to show you is the percentage of FHA mortgages that are out there. I don't feel it's enough to put a dent in the market. So again, you look at how long it took the market to figure out from a median sales price that something wasn't right before it started taking a dive. And then in 2012, when it hit rock bottom and inventory fell below that 5.5 month line, we've been on this wave of equity gains. And Bill, we're over that 8 years. We're getting closer to that 9 years. We're going to get into that 10th year.
The charts are awesome, but visually speaking, what you were explaining before, that correction was happening over 5 years, kind of back and forth. It was just this nice wave. And now it's just this very long wave going down on inventory and this very long upward gain on the median sale price. So that gap can't be good. Just visually looking at this.
Yeah, you would think. It's hard to say if it's good or bad. Is it going to be corrected is the question. And if it is, by what degree? And then how long is it going to take to get back up? We can all look at a historical chart of 50 years, 100 years of real estate and know that over the long run, you don't lose. It hasn't been proven to be a loss yet. You try to bite off the market in these 2 to 3 year grasps. And that's where the problem lies, because especially if you've been in this kind of market for 8 years, 9 years, it's more natural to say, I'm getting close to the turn. Where if you made this decision in 2013 or 14, you had plenty of time to ride that wave and make your decisions. And that's where the conversation comes in with buyers is what kind of home are you looking to stay in? I have a 10 plus year conversation with my buyers that is really one of the biggest things that they should focus on in terms of how long they plan to own their home. And I've got charts for that too. We'll put that conversation into better light.
Can I ask you a quick question? Do you think that that standard 8 to 9 year cycle that you were talking about is consistent across the country in other states as well? Or is this just Minnesota you're talking about?
For now, I'm just going to say Minnesota. I know everybody else has their own cycles. I've got an agent that I've been communicating with, and she says that during the downfall in 2005 to 12, Colorado didn't really have the same experience. Texas didn't really have the same experience. Some of these larger states have these amenities that are less found in other states. They have their own economies almost. You know, you look at Texas, there's talk about them being their own serviceable country, or California, you know.
Yeah, and then you look at those, I don't want to call Texas a micro market, but they're one of 50 states, obviously. But then you have the influx of people coming from, say, California. Texas is being called the new Silicon Valley, right? Austin is this kind of booming area, or the whole Texas Triangle, the Metroplex. There's a lot of people pouring in there because it's favorable for taxes. So people leave California and they'll go to Texas. They get a similar weather pattern, something like that. So you have all of these occurrences. The why is not always transferable completely across the country, right?
Yeah. So a couple other things that I'd like to point out and that come into play with my predictions of the market. There's a lot of stuff happening over here that's not happening now. Okay. Things that could really negatively affect the housing market. So looking back at these charts, I think it's really important in terms of shaping my conversation and where I think the market's going is you got to look at what was happening in certain timestamps. You go, in the 90s to 2005 when the market was leading up. You had all those things that shouldn't be happening, the unverified incomes, the straw buyers, all the things that shouldn't be happening. And then you had the foreclosure crisis, which was just an after effect. Stuff that was born out of that is Renters Warehouse. You have all these facets that came in. You had all this group bulk money that was going into metropolitan areas, buying up tons of homes for dirt cheap, pennies on the dollar. It used to be where people would own their homes for an average of 6 to 7 years. Now that number is closer to 10 to 11. And some of these numbers, in my opinion, have to be swayed by the longevity holds of the investments because there's no reason for them to sell it, especially at bulk money when they had it at such a low price. And the way the appreciation has been happening, increasing their portfolio's value to where they can leverage it against other purchases. That's happening. Then you also have everyone who bought in the low end from 2012 to now, that's gaining so much equity. We had interest rates back in the early 2000s that were near 7. We bottomed out at 2.75%, making the thought of anybody trying to refinance out of that rate a tough question and a tough decision to happen. And then you go, how does all that work and how does it all plug into each other in terms of the housing bubble and how people are going to make their moves? I find it really hard to believe that people are going to walk away from it, especially when the rental market now, it's still, in a lot of cases, still more affordable to purchase because of interest rates than it is to rent. Remember when everybody let their homes go back in the mid 2000s to almost 2010? It's not like everyone just vanished like end of Thanos, right? Like he snapped his fingers and all these people went away. They still had to live somewhere. So that put extra pressure on the rental market. Rental rates went up, rental vacancies went down. Same thing technically would happen if we had a foreclosure issue due to massive job loss, world war, or something crazy happening that is really unpredictable. The rental market's going to be great. Believe that long term. And I think that's also why people are holding on to their rentals. I also think that's why people that I know that I never assumed would be a landlord are also now choosing to buy a secondary home because the numbers still make sense. And they'll make even more sense when we go over the charts that I put together for you guys to view.
What's going to be the factor that tips this one way or another?
Interest rates. I look at it as 3 to 4 things from my knowledge and my guesstimation that there's going to make this market change. You're either going to have a much more harder pandemic that comes in and it's less forgiving, even though COVID's been really tough on a lot of people for a lot of different reasons. But imagine a pandemic coming in that wipes out 20% of the population, and now we have housing available for the wrong reasons. That would be a game changer for inventory. Assuming that's not going to happen, you have to go, what's next? Well, job loss, job market, something big in the world happening to affect that. What are the chances of that? Unemployment's actually pretty good right now. It's been really good, and hopefully it will stay really good. So then you have interest rates, and they have been rising. We bottomed out at about 2.75. Now I believe we're roughly around 3.25. Historically great, but when you look at the numbers and how that affects your affordability, and you look at the buyers who are maxing out at, let's say, 300 or 400,000, if it moves a point, you've now just lost about 10% of your purchasing power. So the buyers who are maxed out at 400,000, now they can only qualify for 360. So the inventory will naturally start growing slowly. And that's where you start seeing that slow trend. Once we get up to those numbers of 5.5 months, you'll see that slow trend in the median start to kind of pan out, and is where I think that goes. From there, it's interest rates, how much inventory do we have, and then how competitive do sellers need to be at that point in time. But we've got a long crawl to get there. 0.8, even if it's 1.5 months worth of supply, I'm thinking this is years. When we get there, it's going to be interesting to see what kind of stimuluses they put into the housing market to try to curb it, because I think that will happen too.
Yeah, it's interesting because I just don't see that the people in charge of the interest rates have any appetite to see them back at the early 2000s. When we bought our house, our rate was at 7.5%, and just it kept falling over time. Obviously, I kept thinking it can't go lower. It can't go lower. I mean, but I don't see an appetite for politicians or anybody else who's connected to interest rates to see them go back up.
Correct. So if we concentrate on interest rates next, I'd want to do with you is buzz through the heartbeat of Minnesota in terms of bad market, good market. Where does all the inventory come from? When does it come into the market? And where do the buyers fit into this? So when looking through this chart of 2004 to now, whatever market we're in, you can see that most of the decisions to list typically happen in December. And then inventory grows, and it typically spikes in about May to June. You take away realtors and everything, the activity is what creates this chart. And this is what's happening. We're just blessed to be able to see it and follow it. And you can see what the housing market did last year in COVID, where we started to do our natural trend up, and then we started to have the lockdowns, and then people pulled their homes off the market for 2 to 3 weeks. And then everyone realized we're not the stock market. And guess what? People need to move still. So then we had that little double peak, triple peak, if you will, before following that natural footprint, getting back to December, bottoming out. And now we're in our crawl back up. The buyer activity, same. They follow the same footprint as the sellers. Everyone's making their moves, their savings towards the end of the year. We're going to start fresh in 2021. If you look at all of the buyers as a full spectrum, you're going to have people who are wanting to get into school districts, make their move before summer hits. Minnesota has got very short summers. Let's all take a pause to really understand that, right? End of graduation time, people have parties, they have gatherings. You get a short reprieve until the 4th of July, more trips centered around that. Then it's back to business before the state fair hits, and then school starting. You can see pending properties still happen, but it happens less. Less competition, less stuff to look at, less activity. Closed sales is just a natural progression of the actives and pendings. I was listening to a couple of your other podcasts, and there was some interesting conversations regarding what markets are seeing the most amount of activity, which ones are the most affected. They really can chunk down these numbers. What we were just looking at is like a 30,000 foot view. Now these charts have the ability to break it down to different price ranges for you. One of the hottest price ranges is that 350 to 500. And you can see year over year, we're down 53.6% in available pre-owned properties, not including new construction. New construction's been on the rise, which is great because we're needing the inventory, but that previously owned down 53.6%. Absolutely amazing. Wow. And then you look at the buyer pressure, it's up 25.9% in that same price range. Extra squeeze, extra juice. If you look at how powerful these interest rates are into the conversation, that 1 million price range and above, up 36%. That is actually the highest yielding year over year growth in purchases, plus $1 million. Month supply for that million plus, 3.7 month supply. That number should be 10, 12 months plus from the pure affordability aspect.
Sure. Wow. But money's cheap.
Yeah, wow. It's almost free. And when you look at these charts for the mortgage calculators that I put together for you, you'll see the power of it. And this is why it all makes sense until it doesn't. This graph right here for you shows us the best of times, the worst of times in terms of interest rates. Goes back to 1971. The early 80s, TV was great, growing pains, family ties, but the interest rate, not so much.
18%. I can't even imagine.
Wow.
When you look at when that market started to change in 2012, notice how the affordability line, even from 1999 to the crash, it started dropping, but we were still at around 8%, 8% when the housing market went on its last previous run to the last previous fall. This is a chart that I think is also important from 2016 to 2019. It shows our dance in between 3.5 to where we almost hit 5%. There wasn't a conversation that I had with agents back in 2018 where we didn't think this was the shift.
And you're talking, just to clarify, you're talking mortgage rates.
This is mortgage rates, yes.
Yeah.
And because affordability is such a big factor, the conversations within our industry was, here comes the shift. We've had a good 6-year run. Here comes the shift. How are we going to start doing our marketing, our conversations, and educating our clients? But then rates ended up falling back down. If I were to scroll back one of those earlier charts about the median value and where that was at and how everything still increased, there was nothing that showed up on the radar that said, here really comes the turn. There was a small flattening out of the median for about 4 months, if I remember the chart right, and then we started climbing back up again. Now, what that means, and this might be a little harder for me to explain all the numbers through the podcast, I'll do my best with it. This is the power of money right now and where it could go. I don't think anyone here or listening is going to argue that getting back up to that 5% is going to be something that we'll never see. We're definitely going to see it. But what does this mean in terms of payment now versus your principal and interest and what you start out with and what you end up with at about 10 years? And I use this 10-year mark because right now that's the average lifespan of somebody owning their home, which I believe is going to change. So let's look at this price range of $400,000. I've got 4 different charts for you to see: the 2.75, 3.25, 4%, and 4.75%. When you look at your mortgage payment, just principal and interest only, this isn't taxes, insurance, PMI, nothing like that. I'm not a loan officer. I used a loan calculator for this. Everything that we can use from the general public. You put in a $400,000 mortgage and your principal and interest is $1,741, starting out at a $400,000 purchase at today's rate, 3.25%. From an investment standpoint, the market's going to do what the market's going to do. From a you standpoint, you have that interest rate for as long as you own that home. And if you're there longer than 30 years, that interest rate goes away. That mortgage payment goes away. Now, banks aren't stupid. They are here to make money off of you. And they understand that people sell their homes typically within 10 years. So guess where you pay the most of your interest? Up front, those first 10 to 15 years. You look at that $400,000, that first month payment, $657 is going towards your principal. You're paying yourself back for being a homeowner. And the bank is making $1,083 off of your payment starting out. Every month, this changes. Interest goes down, principal goes up. Now, if we're all going to take a vote and we all agree that we're going to still be alive in 10 years and we're either going to own a home or we're going to rent a home, if you're renting, that money is just gone. If you're owning the home, you're paying your principal down, you're getting a nest egg, you're going to go through 1 or 2 real estate cycles. That's going to be what that's going to be, but your balance is going to change. Take a look at this principal at 120 months, your 120-month payment. You are now paying $910 towards your principal versus that $657, and you've tipped the scales. It's only $831 towards that interest. Imagine if you put a renter into your property at that point who is covering your mortgage. They are paying your principal down $900+ every month starting out. Now tack on the natural progression of real estate to where over that 30-year span, you can possibly count on that 1.5 to 2.5% appreciation over that time. 75-ish%, one of the statistics I've heard, 75% roughly of the equity, the riches, the wealth that people have earned has been through real estate. This is why the long game works out. How you purchase your property works out. If you're talking to buyers right now and they want to move in 2 to 3 years, not a great decision unless they understand the risk and reward potential. But if they can commit to being there 10 years, you can, this is math. This isn't my opinion. You can tell them where they're going to be on the map. And you look at what this also means in terms of principal savings. Now, this is the 3.25% graph. So in that 10 years, you're going to pay $116,648 in interest. Looking at 4.75% for those who are going to wait and time out the market and purchase when the housing values go down, guess what's going to make them go down? A higher interest rate, higher inventory. But until that happens, we're going to have appreciation. But let's just assume we're looking at the same house, same cost. On a 4.75%, your monthly payment now goes to $2,087 versus $1,741. Your first month principal is only $503 versus the $657. Interest is $1,583 versus the $1,083. $500 more you're paying the bank for the same home that you want to live in and own as an investment. At 10 years, you're not even close to tipping the scales. At 10 years, you're now $808 for your monthly principal pay down starting out, and you're still at $1,278. Your principal and interest always stays the same, remember. It's these numbers that change on a monthly basis, but you are going to spend a lot more money. This next chart, I tried to bring all the numbers together to make it a little bit more digestible. If you look at the difference between the 3.25 and the 4.75 over that 10-year run, your principal and interest payments, you're going to spend $41,520 more out of pocket over 10 years. You're also going to pay yourself down less principal in the amount of $16,073. $16,000 less in your home's equity by trying to wait this thing out. You're going to pay $57,911 more in interest during that time. In 10 years, imagine somebody giving you $5,709 every year just because you made a decision to purchase earlier. This is exactly what's happening for those who understand the numbers now. Over that 30-year interest, you're going to spend $124,000 more in interest. These numbers are powerful. They're real. They will happen eventually. Where the housing market is at that point, really hard to predict. But this is one of the big reasons why you have all this extra pressure on the market right now. And how this ties in for me is you're going to have all these people who have a rate that's 3.5 and under, those who have refied into their current position. It takes 5 years to get to where this 4.75 is, maybe less, maybe more. There's going to be those who absolutely have to move, but there's going to be those who understand the market and that they're sitting on a potential investment retirement vehicle. And there's going to be more entities that come to the market that make the rental process easier. You've got younger generations that absolutely love moving jobs and locations every 2 to 3 years. I can see the housing market having certain sectors of housing be form-fitting just to that. 2 to 3 year leases, people can work remotely. I think in my opinion right now, unless something drastic enters into the market and changes my viewpoint, I think the haves and have-nots in housing in the next 5 to 10 years is going to be a very, very distinguishing thing. And those who understand the numbers now, you're giving away a little future equity sometimes to get into the house that you want. But if it's long-term, it doesn't matter.
Is there really a bubble there, or are people just not moving out of their houses?
I wouldn't say there's a bubble as much as I'd say there's a shift, because the market shifts. It looks like a bubble because you can track the charts and stuff, but it's really just these cycles that we go through, and we will get to a change. It's just a matter of when. And part of the, I don't want to say funny thing about the market is that very few people look at the historical aspect of real estate, but they do understand that they need to live somewhere. It's just survive. You got to survive. You have to live somewhere. You're going to want to get out of your friend's place, out of your parents' place. You're going to graduate into the next stage of life. And you're only going to know what you know at that point in time. So those getting into the market when it's 4.5% or 5%, that's all they're going to know. Everything else that surrounds it, that's more of the bubble to me. What's going to cause the shift?
So, Dan, do you think it's really risky then for people in this current market to be offering 10 to 20% over asking price?
So I love this question a lot because the list price of a home is a price opinion. It's all it is. It's good enough to get your eyes on it. It's good enough to get your attention. It's good enough to get you into the home. It doesn't speak on what time of the year you're in. It doesn't speak on all of the chart information that I just showed you and being able to understand the market and where your leverage points are. And quite frankly, it doesn't speak on the comparable comps from around that subject property that you're offering on. I've seen so many properties listed low for different reasons. Could be just a mix-up, understanding the market, or it could be an agent trying to list it low for, I hate to say a quick sale, but sometimes bragging rights. Outside of 2021 and what the market's doing right now, if you're getting more than $20,000 more on a $300,000 listing, you probably underpriced it. There is an unpredictability factor to this market, though, because there's a lot of money that's coming out to play. Because I've listed a couple to where I'm like, okay, we're probably at the point where we should be concerned about an appraisal. But you still get that 30 over. But it's how it comes together versus why. And it's because of the rates. You got to understand the rates are going up. The conversations surrounding that for those in the purchase position are hearing it and understanding it. And more of them are coming up to bat and it puts more pressure on that moment and on that market, and it raises the unpredictability factor of that performance. But eventually that goes away. We're hearing all these crazy stories going from December until now, but based on the charts, this is also where we live in the lowest amount of inventory. We have 30% more buyers that are pre-approved this year than there were at this time last year. A lot more people entering the market, putting more pressure on it.
What you're telling me is that people are buying houses, they're staying in them longer, and when it's time to go buy another one, they're not always selling the house they have. They're just converting it into a rental agreement, and they're cashing in on somebody else paying a bigger chunk of their principal payment off each month. I mean, that's just amortization. That's how it works. You always pay interest on the front side. If you keep refining all the time, or when you refi when you're 8, 10, 12 years into the process, you just start back at zero again, start paying a lot of interest.
You do if you're refining into a 30-year. I myself, before rates hit a rock bottom, I had 20 years left on my 10-year mortgage. I was at a 4.625 interest rate. I refied to a 3% on the 20-year, lowered my payment, lowered my interest, and I'm saving close to $80,000 over the next 20 years just by refinancing correctly. Again, what's the percentage of people who understand the numbers and are looking at everything other than that instant gratification of, hey, I just now got this lower payment, and not understanding what they might have done on the back end and resetting their clock? There's potential for a lot of bad decisions to be made. But for those who have refied regardless into that 2.75, I've heard as low as 2.4, 2.5 to even 3.5, gets really hard to walk away from that, especially if the rental market is so strong to where you can cash flow on a mortgage plus see your principal reduction plus forecast your appreciation at a bare minimum. That's where the investment conversations come into play. This last chart, it may be throwaway information in terms of our conversation right now, but it is interesting when talking about strategies with sellers and buyers alike in terms of what their competition is and how we can leverage offers in the multiple offer game. Where these buyers are coming from in terms of financing, up to last year, we ended roughly around 73% were conventional purchases. Their next leading contender was cash, 12.6. Cash, all price ranges. I've lost out on $500,000 homes this year to cash.
Wow.
I don't know where this money's coming from, but it's out there. Secondary properties up north on fire. 8.9% FHA. FHA is a different kind of loan. We could talk about that for a while, but the only thing that's sexy about that FHA potential, and you'll be able to replay this podcast maybe in 5 to 10 years, whenever interest rates start getting up to that 4.5%, 5%, FHA is the only one that is assumable to where the next buyer can actually assume that mortgage and assume the terms left in that mortgage as well. So anybody who's locked into a 2.75 on an FHA, if rates go up to 4%, that next buyer, if they qualify, they can take over that 2.75, have 20 years left on their mortgage, awesome principal pay down. They just have PMI to worry about, but eventually the numbers just make sense. Then you have other properties mixed in there, probably VA and rural stuff, and then some distress sales as well. But this is where you would typically market to. Property condition, who you would expect to come into your home in terms of offers. I can tell you the FHA offers, they're the ones that are getting beat up left and right now. Unfortunately, between the haves and have-nots in terms of money being available for purchasing, you're going to have buyers that come in that don't have much of anything more to put down than the bare minimum. Maybe they still need seller contributions, but they are coming in hot and heavy with their offers. And it's often flexing the escalation clauses up to their max levels. The micro strategies involved are a completely different thing to talk about, but all this stuff comes into play in terms of setting those expectations, making yourself a better agent and a better communicator with your clients.
Dan, is this cash that you're seeing coming into the market? Is that some of these cash offers for your house? You see it on TV all the time. We'll buy your house. Is that where that cash is coming from? Or is it just the everyday Joe bringing a suitcase full of cash to closing?
Everyday Joe, it's Pulp Fiction. It's surprising where a lot of this money is coming from. There was some national statistics that I think I heard through our family reunion, or it was through the National Association of Realtors chief economist, of the people who were affected last year versus who weren't. And it was the age group of, I want to say 36 of age and above that had like the white collar jobs that are just crushing it in the real estate market right now. But that also means that the need for the others is just pent up and waiting to pop. So even when we start getting more inventory, as long as the affordability factor is there, the job market's still there, that pressure it's going to be alive. And again, when does it not affect inventory to where inventory starts to grow naturally? It's a really interesting circle that I see us in right now. to where it's hard to predict when that change actually comes. And I think it's at that 4.75 to 5 at these prices to where I think you just can't avoid it anymore. The purchasing power difference is going to be about 15 to 20% different than what you're at right now, which is a game changer in my opinion.
It feels like we could bring on more new inventory too, and that would just be absorbed right up. I'd be curious to talk to a builder and ask them about lumber prices right now and how that's affected their ability to stay affordable with their inventory.
Well, I'm working with several clients that are purchasing new construction, ranging from your national builders to local custom builders. And it's actually very interesting that the local custom ones have better turn times. Everyone's affected by the pricing the same amount, but these national builders who have, contracts with these subcontractors, so they have a limiting amount of them. But I know some of these national builders, they've stopped selling lots. They're only building spec homes because whether it's appliances, cabinets, COVID shutdowns, with their crews, they have this swing to where they've had all these delays to where they can't price protect their profit margins. So they couldn't build them in the timeframes guaranteed that they were originally seeking. So now they're building specs and releasing the prices once they're more confident on when they close.
The unpredictability has really impacted that.
It's such an amazing industry and how it swings. I mean, through the foreclosure era to now, very dramatic results between the buyers and sellers, opposite ends of the spectrums. But how it all comes to play together on a micro level is just interesting. So how you buy is super important. Why you buy, also important. And how and for how long is really the conversation to be had right now.
Buy and hold. That's what I learned. Once you own that house, you never sell it. Just rent it out to somebody else. When you're tired of it, you just rent it out. Go buy another one.
This is just really interesting, Dan, just all of this information and just kind of hearing the reason for the crash back in 2008 to 12 and everything that led up to that and how you're not seeing, parallels in this cycle and that it's probably not going to be a huge crash or a big burst. It's going to be just, more of a gradual thing, it sounds like.
There'll be a pause. If everything goes the way I think it goes and there's nothing dramatic that enters the scene, there'll be a pause. And then you would think a pullback. It's the natural selection, if you will. And the pullback might feel a little bit greater because of the things that are going on right now, but we won't know until we get there. I'd be a fan if they were to give us a little bit more data in terms of the homes that are being sold right now, if there was some simple check boxes that were added to the MLS just for the professional's eyes, realtors and appraisers, that, hey, this home appraised or it didn't appraise. What great information would that be in terms of making sure that the neighborhood's value isn't getting, over inflated. And the normal conversation is it's only worth what somebody's willing to pay, but appraisals exist for a reason. There's got to be somebody that governs the values because the mass majority of people use financing. The lending institutions say, hey, this is our guardian with the appraisal. And if that data is not available for them to be able to fact check that somebody's putting $50,000 down over cost, set a new bar for that neighborhood that isn't realistic for the larger percentage of buyers. I think that's where my attention is going to go next, outside of the withhelds and the hidden inventory again. That's the one I'll be paying more attention to.
Is there any data out there that tracks that?
The appraisal?
Yeah.
No, nothing. It's all individual in terms of the appraisal and the appraisal companies.
From what you've seen, just being a real estate agent in this market, have you seen a lot of people still offering cash over, what the appraised value is and the deal closing and going through? Have you seen that happen a lot?
Yep. So my natural progression and check down is if we're on a brand new home on the market and I'm with my buyers and they have interest, first go to is the comps. Is this home priced correctly? Is it priced over? A lot of the times it's priced over. It just is what it is. One of two things are going to happen. Either that home sits, it's not rewarded, even though we're in the market that we're in, and I could pull up 100 homes in any one of the cities that you live in, and you will find homes that have been on the market for a few weeks, if not longer. Eventually, they end up going through the price reduction cycle until they get to market value, unless they can't get there and they decide to hold it. If you end up in multiple offers, all bets are off. In this market right now, if multiple offers exist, even if the home is priced at or above what might be perceived list, chances are if it's within the first day to 2 to 3 days, you're going over. At that point, let's talk about the long-term capabilities of this home for that purchaser. Can they grow into it, or are they going to grow out of it? And then what is it worth to them? If we write an offer and it sticks, great. If it doesn't, we move on. More business decision versus emotional, and just setting the stage so that hearts aren't getting broken every day. Same conversation if it's been on the market for 3 weeks, they might be in line for a price reduction. Your offer strategy changes and you start talking about the other things. But anything in the first couple of days, it's what that house is worth to you. Do you want to do unlimited dollar amount of an appraisal gap coverage? One of my go-tos is I'll never, ever recommend waiving an inspection. But based on all the things that I've learned from Structure Tech and previous construction knowledge and history, I've got a pretty good parameter of pointing a whole bunch of things out. There's, of course, tons of things that I can and see, carbon monoxide up in the attic, electrical stuff, but a lot of visual things I can point out. So I try to prep my buyers in terms of expectations on cost and what would be in a general home inspection, and then say, here's the other things that we can do. I recommend getting an inspection, but I'd be surprised if there's more than $4,000 worth of damages. Anything that I can't see, you're probably starting at $4,000 and up. So let's take the boogeyman out of the closet for the sellers and say, we won't ask for any repairs that fall below X amount. And if the buyer is comfortable with it, we use that as one of our stepping stones in hopes of getting the offer accepted. The other side of the fence, you got a seller who's freaked out about, one, the market being that crazy. Is it going to perform? Is it going to appraise? Are they going to be rewarded? And then what kind of buyer are you going to get? So you got to put as many guarantees up front as you can right now, which the typical big ones are inspection, appraisal gap coverage, earnest money. What are you willing to walk away from and risk as a buyer? And no conversation should ever be the same with that. It should all be customized to your client.
Are you having all these conversations with all your buyers? Do you kind of sit down and go through this?
Yeah, I rip off the Band-Aid right away. I mean, as soon as we're done shaking hands, I tell them I don't want to sugarcoat anything. Anybody coming into the market's heard the stories anyway. But guess what? They're here. They want to buy, and I need to figure out the reason why. And I have to be able to educate them as to why it is a good time or why it isn't a good time for them, and be prepared to do what it takes if it's still a good time for them at the end of our conversation.
It's like a PhD level education in the Minneapolis market.
Yeah, I was just going to say, I mean, how many agents do you think do this kind of level of education and awareness with their clients?
Very few. I'm fortunate to know a lot of very detailed people out there, but like any industry, you've got people who are just starting that are going to be absolutely amazing as they continue to grow and educate themselves. But there's a time frame that it takes. I mean, you guys train people for probably 6 months to a year before you even let them go into a home.
2 weeks, Dan, just 2 weeks. And we see
2 weeks.
We're working on making it more efficient, Dan. We are. We want to make sure the quality is still there, though. But yeah, it takes a while to learn all this information.
When you're in the real estate seat and you have to answer some questions about financing, lending, how that plugs in, the expectations and the trials and errors and pitfalls that can come from it, title work, the home, the offer process, and all the way through, you are the middle person in the transaction. And now you have the code of ethics and your fiduciary duty. And we're getting compensated well at the end of the day when you do your job correctly. So in my opinion, you should take this as seriously as possible, educate yourself to the best of your abilities, and just be that great communicator. Put that consumer first. The rest of it falls into place.
That sounds good. So Dan, can you tell everybody where you can be reached at?
Well, I'm with Keller Williams Classic Realty. It's the Minnesota Strong Home Team. Cell phone number is 763-350-5850. And my email address is dan.mnstrong@gmail.com.
I think everybody, when they're listening to this podcast, should download the show notes because it's going to make a lot more sense. There's a lot of detailed information here. It's really interesting to look at, but I think we should just indicate that, do everybody a favor, because this will make so much sense when you see it visually. So, but Dan, thank you very much for spending some time with us. You're like the professor of real estate. We just get so much information. So thank you. I appreciate it so much.
I appreciate the opportunity to share my thoughts. And hopefully when we look back at this in 5 to 10 years, that at least I hit the board with some of the darts.
All right, Ruben, do you have anything before we put a wrap on this?
No, I'm letting this all digest. That's a lot of information, Dan.
Yeah, he's taking it in. I love it.
It is. It's a new perspective. And I feel like coming away from this information, Dan, it's a very different perspective or feeling that I've gotten from, other real estate agents and other people that are looking at the market too. It's all based on numbers and it makes sense. So I'm just trying to process it too,
Tessa, it's all emotion. There are no numbers in this game.
It's true. If you have the ability to separate more so the whys of why I want to buy a house, and I don't ever want to rob that experience from a buyer. And in a balanced market, you don't have to be as stringent on your conversations because you're in a balanced market. But if you're not setting expectations up, there's going to be a wide range of emotions and heartache and heartbreak. This market isn't for everybody. Even with being prepared, knowing that you're going to be stepping into a minefield, there's going to be some people that just are going to take 2 feet in. They're going to go, you know what, not my time. And that's all right. As long as they're educated and they understand the process, that's all I can ever ask for.
Sounds good. Thank you, Dan. We appreciate you spending some time with us. Everybody, you've been listening to Structure Talk, a Structure Tech presentation. My name is Bill Ulrich alongside Tessa Murray and Ruben Saltzman. Thanks for listening. We will catch you next time.
For more information on how we can provide you with the right information about your home before you buy or sell, contact us at structuretech.com.